Hey everyone, welcome back to another dividend investing video. Q1 of 2023 is now behind us, and over Q1 the S&P 500 is up about 8% as stocks have been recovering from the bear market of 2022. Meanwhile, our favorite dividend ETF SCHD is down about 2.5% in that same time, so there's still some solid dividend-paying stocks available at great prices. Today I'm uncovering 4 in particular dividend growth stocks that I think make a lot of sense for dividend investors' watch list for the month of April 2023 and going into Q2 and Q3. It's all about collecting those sweet dividends for passive income. So let's get to it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Alright, I'm going to get right to this, my friends. I do want to remind you that I get much of my research from the website, Seeking Alpha, and much of this information is made freely available. But if you've been thinking about getting their premium membership, then I've got good news for you. My viewers have access to their special deal where you can try the premium features out for 7 days, and if you like it, you can have your first year for only $99. This comes out to about $8 a month. I'm happy to be able to provide you guys with this great deal, and it's a fantastic way to help support the channel. And stick around until the end of this video. We'll share a couple additional stocks I think belong on your watch list for the month of April, a couple bonuses, okay? So let's do this. The first stock we're looking at is Automatic Data Processing, ticker ADP. ADP is a New Jersey-based provider of human resource management software and services. It operates in 2 segments, employer services and professional employer organization services. The employer services segment offers cloud-based platforms and human resource outsourcing solutions. It manages payroll, benefits administration, talent management, insurance, retirement, many other HR-related services. The PEO services segment provides HR outsourcing for small to mid-sized businesses via a co-employment model. They have been in business since 1949 and are a pioneer in human capital management. Shares of ADP are down nearly 10% year to date, and over the last year, shares are down about 9%. So it's come down over the last year. Now, Bank of America Securities downgraded ADP and its competitor Paychex just the other day, as they are expecting slower revenue growth. They note that these companies underperform the broader market historically when in the early stages of when unemployment is on the rise. But they go on to note that the businesses are structurally sound and the stocks can be viewed as relative safe havens in extreme market volatility. So that's important to take note of. ADP's forward PE is trading 10% below its 5-year average, and really for the first time since the COVID crash situation of 2020, this stock has been trading above its already premium pricing. This is definitely a premium valuation, but I would argue for ADP, a 25 PE is pretty darn cheap, and I'll show you why. The 5-year average dividend yield of ADP is 2%, so ideally, we want to lock in a better yield on cost than its 5-year average. Currently, shares are yielding 2.34%, and that's 17% above its 5-year average, and that's another sign the stock is potentially undervalued. Annually, ADP pays out $5 a year. The dividend is paid in quarterly payments of $1.25 every January, April, July, and October. We just got our dividend on April Fool's Day. ADP is an amazing dividend growth stock, folks. It's nearly a dividend king with 47 years of dividend growth, and the dividend has been growing at a rate of 13% on average over the last 5 years. The last announced raise back in November of 22 was a 20% raise. Now, in terms of payout ratios, ADP is very consistent, hanging out in the high 50s, low 60%, both in terms of earnings and free cash flow. The Simply Safe dividend safety score is 97. Notice that the beta is a little below 1, so it should trade slightly less volatile than the broader market on average. ADP is managing to grow its revenue every year. Looks like they do about $1 billion more every year, and that's what they've done over the last 10 years. That's $17.2 billion over the last 12 months. Pretty impressive. ADP also participates in a sweet share buyback program. There were 487 million shares outstanding back in 2013, and today there are 418 million shares outstanding. They've reduced their share count every year. A nice little bonus for us investors. You love it. Now, if you're interested to see how ownership is comprised, almost 82% of the shares outstanding are held by institutions. Think, Vanguard, Schwab, BlackRock. 0.12% is owned by insiders, 0.05% is owned by the state, and 17.88% is owned by us, we the people, the public. And I do think shares could continue to fall over the next few months. I've identified this as a quality company that I feel good about dollar cost averaging into, and even happier to do so when it's in the red like it's been. And ADP has been one of my worst performing stocks as of late. I'll be continuing to buy it as I know over the next decade employment is going to come back. It's going to be cyclical, right? More people are going to come into the workforce. ADP will be making sure these folks are getting paid, while we as shareholders are also getting paid. So I think ADP at least deserves a spot on your watch list for what they do. You can also get some exposure at is 2.79% of SCHD at the time of publishing. Okay, the next stock I want to look at is Realty Income, ticker O. Realty Income, the monthly dividend company, is a company dedicated to paying its shareholders a growing monthly dividend. Realty Income is structured as a REIT, real estate investment trust, and its monthly dividends are supported by cash flow from over 11,000 real estate properties located in the United States, the United Kingdom, and Spain. These properties are subject to triple net leases. Now here is a look at their 10 largest tenants. You probably heard of all of these guys: Walgreens, 7-Eleven, Dollar General, Dollar Tree, FedEx, LA Fitness, Sainsbury's, that's a UK grocery chain, BJ's Wholesale Clubs, love BJ's, CVS Pharmacy, and Walmart. And Walgreens is the largest tenant at 4% of their rents. Year-to-date, shares of O are down 2%, but zooming out over the last year, shares have dropped about 11%. When valuing REITs, price to earnings, PE is pretty meaningless. The metric we want to look at is price to adjusted funds from operations. You could think of AFFO sort of like free cash flow for REITs. Realty Income has an average 5-year price to adjusted funds from operations of 18.2, but today shares of O can be bought at a much lower price to adjusted funds from operations of 15.7. Now shares of O today are yielding at 4.88%, and this is 12% better than its 5-year average of 4.35%. Ideally, I like to snag my shares of O at that 5% yield, really close to that right now. Either way, we are in undervalued territory in my opinion, based on this metric. Realty Income is paying out $3.06 annually for every share. These payments are made in monthly payments. Right now that amount is 25.5 cents per share. Now notice Realty Income increases that payment slightly multiple times throughout the year. And those little raises throughout the year add up. Over the last year, the dividend has grown by 4%, and Realty Income has been raising this dividend for 28 consecutive years, making them a dividend aristocrat. Now looking at the dividend coverage, the dividend makes up 77% of forward adjusted funds from operations. That's looking pretty solid. Realty Income has done a swell job reducing that dividend payout ratio over the last few years. Their declining payout ratio has prompted SimpliSafe Dividends to give O a safety score upgrade recently. Today they sport a safety score of 80. This is pretty solid for a REIT, as REITs are usually seen as riskier. Notice O has a nice low beta of 0.56. This is just one to buy, hold, and collect reliable dividends every single month. They make it very easy. Realty Income has had a wonderful last decade. They've increased their sales by a couple times. They brought in $0.78 billion in revenue in 2013, and in the last 12 months we're talking about $3.34 billion in revenue. And increasing revenues like that helps increase their cash flow, which helps increase that sweet monthly dividend. Now looking at ownership, institutions hold 82% of shares outstanding, insiders hold about 0.13%, and the public holds the remaining 17.84%. Very standard looking. Wall Street rates this stock a buy at 3.68 out of 5. Out of 19 analysts, 9 rated a buy or strong buy, and 10 rated at a hold. The average analyst's 1-year price target is $70.84, representing 13% upside from where it is today. And if you combine that with their near 5% yield, that's a potential return of 18% over the next year. Look, I just bought some O last week. I've added about 5 shares. I'll be talking about this more in my next Roth IRA investing update. I think Realty Income is just a no-brainer for serious dividend investors. If you need real estate and need a REIT exposure, I particularly like it at that 5% yield or better, and that's a $61.20 to get it at 5%. That's kind of where I target my buys when I look to beef up my REITs in the Roth. All right, so the third stock on my list today is Tyson Foods, ticker TSN. Tyson Foods is, well, a food company. If you eat meat in the United States, you're likely a consumer of their products. They have 4 segments with beef, pork, chicken, and prepared foods. Here's a look at some of their brands. These are real well-known brands. You got your Jimmy Dean sausage, your Ballpark Franks, your Hillshire Farm, Sara Lee, Look, times are tough for Tyson, as it is for most food companies. Just last month, they made a decision to shut down 2 of their chicken plants and laid off 1,700 employees, unfortunately, in an effort to combat the current economic climate challenges. So year-to-date, shares of Tyson Foods are down about 6%, and shares have fallen dramatically over the last year, more than 33%. At the time of publishing, we're really not too far off from that 52-week low. Tyson's PE is at 13.5. It's shot up a bit on recent earnings, a tad higher than its 5-year average PE of 11.7, but still considerable discount to the sector PE of 22.4. Shares of Tyson are yielding 3.2%. This is an astonishing 42% above the 5-year average, suggesting Tyson Foods is at a nice value right now for dividend-minded investors. Tyson pays out $1.92 annually for its dividend. They pay this out quarterly in the amount of 48 cents. The current pay is in the popular dividend months of March, June, September, and December, and the next ex-dividend date is May 31st. Plenty of time to get in for that next dividend payment. Tyson Foods has been paying their dividend for 31 years without reduction, but only began growing their dividend payment about a decade ago. But in time, the dividend has grown at a rate of 13% on average, and that's based off the last 20 years. Over the last 5 years, we're talking 15% per year. The latest increase is a little bit on the lower side at 4%, but if you look at the inflationary environment with cost rising, it's reasonable to expect that growth is going to slow some. The dividend makes up 43% of forward earnings, below that 70% preference we like to see for consumer staples. Really, it looks great for a packaged food company. The rock-solid Simply Safe dividend score of 99, suggesting this is one of the consumer staples we can buy and hold and count on for reliable dividend income. Now, revenue has grown nicely over the last 10 years. In 2013, Tyson Foods brought in $34.4 billion in sales, and over the last 12 months, they brought in $53.6 billion. Now, here's how the shares outstanding are distributed based on ownership. Institutions hold about 68% of the shares outstanding. Corporations hold about 20%. Insiders hold just over 1%, and we, the public, the remaining 10%. Wall Street analysts rate Tyson stock a hold. Out of 13 analysts, 4 rated a strong buy, 7 a hold, and 2 a sell. The average analyst price target is $69.91, representing a potential 16% upside from today's prices. Times have been challenging for companies like Tyson, but you have an opportunity to get Tyson a starting yield above 3%, which represents a unique opportunity, as we can see in this 10-year dividend yield chart from Seeking Alpha. So I would say if you believe that 10 years from now, the demand for products sold by Tyson is still going to be around and that Tyson Foods will still be a leader in the industry, this looks like a great time to be getting into a position in this consumer staple, in my humble opinion. All right, the last stock on my list for April is U.S. Bancorp, ticker USB. U.S. Bancorp is an American bank holding company based out of Minneapolis, Minnesota, and is the parent company of U.S. Bank National Association and the 5th largest banking institution in the United States. They provide banking, investment, mortgage, trust, and payment services to individuals, businesses, and government entities. Today, they have over 3,100 branches across the western and midwestern United States. Year-to-date, shares of USB are down a whopping 21%. These were hit hard along with many of the other financial stocks earlier in March with the bank failures. Over the last year, shares are down 33%, and today we're not far off from that 52-week low. So this one has been beat down brutal. Valuing banks is a little tricky, but if we were to look at the PE, currently USB is trading at a 7.1 PE, which is a dramatic drop from its 5-year average of 12.5. And shares of USB are yielding a stunning 5.74%. This is the 71% increase off its 5-year average. Things have really gone south for US Bank stock lately, but I think this could really be a great opportunity for those who want to lock in that 5.5% yield for what looks like a pretty reliable dividend to me. It's been paying this dividend reliably in the months of January, April, July, and October, in the amount of 48 cents per share for a total annual payout of $1.92. The next pay date is April 17th for those of you who do own shares. The U.S. Bank has a nice track record of dividend growth since their cut of the 2008 recession, growing at an average rate of 10% annually over the last 5 years, and that's 12 years of consecutive dividend growth. The USB dividend is covered by 39% of forward earnings, keeping it below the max level we want to see for banks, which is 40%. Banks do have special requirements and all cut their dividends back in the last recession. And because of this, Simply Safe Dividends is generally not very kind to American banks, and they give USB a safety score of 55, which is borderline safe, although it's better than some of its peers. Now, in addition to the dividend, USB has also been buying back shares to return more value to shareholders. In 2013, there were 1.85 billion shares outstanding, and today there are 1.49 billion. Let's look how ownership is spread out through shares. Institutions make up 76% of the outstanding shares held, while we, the public, hold about 23% of the shares outstanding in U.S. Bancorp. Wall Street ranks the stock a buy, 3.76 out of 5. Out of 26 analysts, 13 rated a buy, 12 a hold, and 1 a sell. And check out the price target on this one. The average analyst price target is $51.61, representing 47% upside from current levels. So there's a lot of potential with this one. Certainly, this is the highest risk, highest reward play out of my 4 choices today. It's not one that I own personally yet, but I am impressed with a lot of what I'm seeing with this one. I kind of wish I owned it, and I'm continuing to do my own due diligence, and I hope this helped you with yours. All right, now let's talk about some of the other picks, bonus picks here I think are still attractive right now. First, we have Bank of America, ticker BAC. This is a stock I've been buying a little bit here and there every week. Banks continue to look attractive after all that craziness in March. And B of A still hanging out below $30, which is where I like to pick this one up. I like this one for the same reasons I like US Bank, but this one's a little less volatile. It feels a little safer to me. Bank of America sports a sweet 5-year dividend growth rate of nearly 15%. So this one I'm going to continue to add to while it's under that $30 and around that sweet 3% yield. But yeah, it doesn't have that 5.5% yield of US Bank, which I can see why that would be more appealing for you guys right now. Next, I think Pfizer, ticker PFE, is still looking like a snack at these levels, down nearly 19% over the last year. This is an extremely reliable cash flow machine, sporting a low payout ratio coupled with a 4% dividend yield. And Wall Street analysts see about 20% upside over the next 12 months in Pfizer. So this could be a good time to mix that high yield of 4% and hopefully some capital appreciation over the next year or two. Pfizer, out of the pharmaceuticals, is a very solid one to keep in mind, especially right now, I think, compared to some of its peers. And my final bonus pick is Union Pacific Railroad's ticker UNP, and we highlighted them last month. Still looking quite appealing at these levels. One of the strongest dividend growth stocks over the last decade in the industrial sector. The near 15% 5-year average dividend growth rate, generous buyback program. These railroad companies have serious moats, and UNP is the largest and my favorite of the group. Shares are yielding 2.69% today, and this is 27% above the 5-year average of 2.11%. So if you want to own one of the railroads, I like UNP right now, and it's one of my own top holdings. I hope you all have a wonderful holiday weekend. I'm going to be looking for one of those Cadbury Easter eggs made by Mondelez, who I happen to own in our Dividend Growth Income portfolio. And hey, I did just put a video out updating our progress in that portfolio in the month of March. 6 months of building this one up. And I hope you'll check that out. Next, you can check it out right here. And until next time, my friends, keep investing.